Welcome back, traders. It's John, and it's time for a general market update. It's August 25th, 2023. Just a reminder, the presentation is by Rain King LLC, and I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. So the agenda this week is to look deeper at this Nasdaq correction. There's questions about if we had a follow-through day this week. We'll go over all of that in detail. Then we're going to talk about the NVDA earnings reactions and the Fed that just spoke about an hour ago. And then we're going to talk about what would need to happen in order to change the trend, and then we'll wrap up. So let's get into this NASDAQ correction. So on the right is a daily chart of the NASDAQ composite. So far, we've had an 8.9% correction. And there's been some questions about, did we have a follow-through day? First thing I can help you with is go to my November 19th, 2022 update video at the 3:30 mark. I talk a lot about what is a follow-through day and why they're important. Now, from my studies, when you have a correction that's at least 8% or more, I really believe you need a follow-through day to reignite and resume the uptrend. It's different than a pullback, which is maybe 3 to 5 or 6%. So what is a follow-through day? It's when day 4 or later of a rally attempt, we get a 1.25 gain minimum on increasing volume from the previous day. Now, there are rare occasions when you can have a day 3 follow-through day, but only if you have 3 very powerful up days. Usually the rally starts when you have a blue day that closes up, and that's the start of the count at day 1. Now, in this case, we didn't have a blue day starting on day 1 here at the lows. And people would say, if you've gone to market school or IBD webinars, is that a pink rally day? Now, yes, a pink rally day is typically a red day, but it closes in the upper 50% of the range. And that in certain instances can be counted as day 1. So if that were day 1, we have day 1, 2, 3, 4, and people are questioning this day right here. Was that a follow-through day? Now, in a follow-through day, numerous stocks will be breaking out of proper bases. So that's important. And what is the market environment at the follow-through day? You know, do we have net new highs? What's the breadth look like? Is the volume above average? That would give us even more conviction. Now, you'll notice here, if you don't count the pink rally day, you've got 3 blue days. And the question would be, well, is that a follow-through day? Well, we need to see 3 very powerful up days. These are not 3 powerful up days. You can see the volume was declining. It's well below average, very, very poor volume. And one of the days is not powerful, it closes near the bottom of the range. So even though you have a pink rally day, you can count this as day 1. So you are at the day 4. But what does the other criteria tell us? Well, you know, we didn't have a day 4 follow-through day gain with increasing volume from the previous day. It wasn't a day 3 of 3 powerful days. We didn't have a blue day, but we did have the pink rally day. And do we have stocks breaking out of proper bases? No, we don't. Most stocks are actually breaking and showing poor charts. And then you look at the general market. And you look at the general market and you say, no, we don't have net new highs. We don't really have good breadth leading up to this follow-through day. And the volume has been way below average, not showing any conviction in the buying. So I don't consider that to be a follow-through day. And then the action on Thursday kind of confirmed that things aren't acting right. So go deeper onto the new highs, new composites for the NASDAQ. You know, we've been looking at this weekly. And you can see this has been warning us for weeks that the deterioration in the market. You can see the increasing new lows while new highs are drying up completely. The new high level, which I've drawn this yellow line at approximately 20 new highs, you know, we're way back at levels we saw during the March correction. So this is just not healthy. It's not conducive to the market moving higher yet. If we switch to the S&P 500, and this is as of Thursday's close, you can see here again that this little low volume rally that we had off the lows was really, really poor. It ran right into resistance at the 50-day moving average. You can see that the up-down volume ratio is now below 1, which really is showing distribution versus accumulation. So we came down to this swing low to get some support. The question is, will this hold if the market continues lower, or where would the next support be? Probably down in this, and I'll call it a zone between 4,200 and 4,250 would be the next area of support, but that's a lot of pain with the S&P if it continues. Further evidence, stocks in the S&P above their 200-day moving average has had a sharp decline below 50 now. So again, this is just telling us this rapid deterioration under the hood. Now, this is a chart that I saw posted from Bloomberg that's showing the VIX seasonality. And it's showing from 1990 to 2022, what is the average seasonality of the VIX? And then the blue line is what it's been tracing out this particular year. So you can see that there's been a pretty strong correlation between this year and the seasonality of the VIX. Unfortunately, it's showing you that if this were to play out, we would be looking at a period coming before us in the next 2 months of higher volatility in the VIX. So remains to be seen, but it's something to have in your back of the mind. We've talked about August and September are very weak periods for the market, and it looks like maybe we're going to experience some more volatility. So Jackson Hole and the NVDA earnings reaction. So let's take NVIDIA first. Now, we all saw that it had a fantastic earnings report, explosive guidance. It was a beat and raise quarter. There's a lot of attention being put on NVIDIA because it seems to be the last man standing from the growth stocks. Now, on the positive side, if you have been in the stock, you bought maybe at the last earnings report or prior, you've got good gains. So that's really good, and you can probably hold the stock, continue to hold it. You may even have done the second thing here, which is picking up more shares at the 65 exponential moving average, where the stock right here got support right off the 65-day, and we covered that a couple of weeks ago. And it also coincided with the 409 price level, which was the 1 trillion valuation. That's exactly where NVIDIA got support. Okay, so those are all positive. And if you've got in early, you've got some cushion. You may be able to hang on to your position. But if you were chasing, there was a lot of excitement leading up to the earnings report and a lot of eyes on the stock. I made a number of comments over the past few weeks. When it had this rally, it stalled out under the 20-day moving average with 4 closes below the 20-day moving average in a row. Not a good sign. It wasn't able to really push higher. And this was amidst a lot of price targets, 800 price targets, $1,000 price targets. And I mentioned that if that can't move the stock, what's it going to take? Maybe the earnings report. And I think it was Tuesday, NVIDIA had a very, very strong day. But if you looked under the surface at the market internals, they told you it was a very weak day. And I mentioned that was kind of like lipstick on a pig. NVIDIA was getting a lot of attention, but underneath the surface, my tweet was sharing that we had new lows, negative breadth, and it was really not, NVIDIA was not reflecting the broader market. And then right before the earnings report on Wednesday, I mentioned that there was a lot of excitement about retail, thinking NVIDIA was, gold, and that it would automatically be a winner. Now, the earnings report were super strong, but again, you can be surprised when it's obvious in the market. That usually does not work. Now, so shockingly, you see all these price targets for NVIDIA, 600, 800, 1200. So if all of these price targets are so much higher, why aren't the institutions gobbling up stock at below 500 if they believe it's going to 1,000? So it doesn't make a lot of sense. Institutions, I think, are more keen on trapping the retail investor, driving the stock down, and then accumulating more shares between perhaps 440 and 500 to build their positions out. They don't want to jam it high, too fast. So that was the point of the tweets. NVIDIA has experienced resistance at 500 a few times, and it was clearly rejected there on the earnings reaction. The market is in correction and very weak internals. And again, I mentioned the obvious does not work very often in the market. And the earnings reaction was sold off very, very hard. And it actually became a sell the news event. Institutions used the excitement around NVIDIA to lighten up or distribute shares of their growth stocks across the board, not only in NVIDIA perhaps, but a lot of other growth stocks got hit very hard on Thursday. So there's definitely some rotation out of growth. So NVIDIA, if NVIDIA can't drive the market higher, that's a really bad sign for the general market, particularly growth stocks and tech. Now, the Fed just spoke about a little over an hour ago. Couple of really basic points. Powell reiterated a very hawkish stance that further rate hikes would happen if they needed, based on the data that they were getting. And he also talked about a lot of data, and he seems to want to have more aligning data points that reflect that inflation will consistently come down to the target of 2%. So that's important, very data driven, and I think they want to see more consistency. Now, last week I showed you the CME's forecast for the September, and there was only a 12% seeing a rate hike in September. That doesn't seem quite aligned with the bond market and yields rising. So I looked this morning, the 12% is up to somewhere around 18%. To me, I'm not a macro guy, so take it for what it's worth. This doesn't seem aligned to me with what Powell's saying and what the projections are and what the bond market is actually doing. So we'll have to see how it plays out. Now, what's it going to take to change the trend? Prove it, is what I say. So what are we looking for specifically to change the trend? I've always said that once you get a pullback or a correction, the next rally is really going to tell you under the surface if it's strong or weak. And this rally that we had, which was only a couple of days, was very, very weak, negative breadth, expanding new lows. And again, in my book, the correction of 8% in the Nasdaq means we do need a follow-through day. And I mentioned what the follow-through day would entail. And most importantly, we want to see proper bases in growth stocks that break out, and there's setups. Many, many charts in growth right now are broken. They need lots of time to repair, weeks and weeks of repair. Proper charts got to have at least 5, 6, 7 weeks to rebuild themselves. So we don't have that. It's going to take some time. The market needs time. If you're in a stock with some cushion, you've got a different situation, and possibly you could hold. I also like to see a couple of other things. I want to see at least 3 consecutive days where the index closes above the 20-day moving average. That's the exponential moving average. I want to see positive breadth of maybe 3 to 1 or 4 to 1 or better for at least 2 to 3 days to show you that there's some real positive signs underneath the surface that the market is changing. And sentiment. In sentiment, strong markets tend to ignore bad news, but it seems that the market in the last few weeks is actually ignoring good news when there was some positive data points with the jobs report and the CPI report, but yet the market really did not look at that favorably, and we've been in the correction. So those are the things that I'm going to be keying on to look for a change of trend. So hopefully those help you. Now, to wrap up today, I think it's important to stay really, really grounded. And this is where you need to follow your rules and stay objective. We want to follow the trend. We're trend followers, and I'm a position trader, which follows trend. You want to follow your buyer rules, and you need to be very careful about following your exposure level rules. So I know that NVIDIA had a fantastic report. It was blowout quarter, but it was actually a sell the news event. Institutions exited growth names. So we have to take that in consideration because we follow the institutions. They drive the market. Now, the internals of the market currently are very weak. It certainly looks like we're going to go lower. So avoid FOMO. Don't be chasing stocks when the market conditions are telling us it's not a favorable environment. Always think in risk reward. We want to stack as many odds in our favor, stacking those for a trade. And it's still no guarantee that a trade will work even when you stack the odds. But when you're in a market with weak conditions, the odds are actually stacked against you. So it's even smaller probabilities that a long trade would work. Exposure levels should be dropped pretty dramatically. You could be at cash right now. Maybe you've got 20% if you've got some positions that are holding good cushion. And I would say good cushion would be 50% or more. If you only have 10, 15, 20% cushion, that could get wiped out if we continue with the market going lower. When the indexes continue to correct, growth stocks will correct 2 to 3 times what the index does. So I'd be very defensive here right now. So here's our quote of the week. Knowledge born from actual experience is the answer to why one profits. Lack of it is the reason one loses. And that's from Gerald Loeb in the book, The Battle for Investment Survival, which everyone should have a copy of and read in their financial library. Now, a couple of upcoming events for me at Rain King. The San Francisco meetup is going to be next weekend, Labor Day weekend, the 1st and 2nd. It's a virtual event as well as in person. If you want to join it virtually, go to meetup.com, search for the IBD meetup event, and see if you can get more information there to sign up. I will be there in person speaking on the topic of insights from the earnings reaction gap research study that I did in 2021 and 2022, which has evolved into the earnings reaction gap course that I did with Ticker Monkey and JT. Now, I also want to emphasize one more time the Blue Sky 6 virtual event, and this is Rain King's once a year all day event. I want you to save the date of November 4th. It's an all day Saturday virtual event. We want to, hopefully you're going to hold that date. We have got a great lineup of speakers, and I'll be issuing a short video during the coming week, and I'll announce all the speakers and how the event is shaping up and some of the topics. So hopefully look for that this week in my Twitter feed or my YouTube feed. So thanks, everybody. It's been a exciting week in the market. A lot of volatility is picking up. So that's the general market update for August 25th, 2023.